Stand by! Here comes the Formula Guru! Guru will tell you how to calculate correlation. Generally, market experts and investors try to look at how two variables are related, which is also known as correlation. Like if the oil price increases, then what happens to the share market? Or when the share market increases, then what happens to gold? After calculating this correlation, many investors get an idea about the direction of their investment return. Guru says that the correlation coefficient tells us how strong is the relation between movements of two variables. Its value lies between -1 to 1. -1 correlation says there is a perfect negative correlation between two variables, while a +1 correlation suggests that there is a perfect positive correlation between the two variables. If the correlation between two variables is 0, then it means there is no linear relation between two variables. If you get a value less than -1 or more than +1, it means you have made a calculation mistake. This value is used a lot in finance and investing. To calculate correlation, first of all, we have to see whether there is any covariance between the two variables or not. After that, we calculate the standard deviation of both the variables. Then we divide the covariance by the standard deviation of both the variables. This gives us the value of the correlation coefficient. Pearson correlation coefficient tells us how two assets are related to each other. If the price of one asset increases and at the same time price of other assets also increase, then both the assets have positive correlation. Let's say we have crude oil and Nifty. To calculate correlation, we look at the average price of both the assets. Then we look at how much specific prices have deviated from the average price. Like if the Nifty price is higher than its average price, then what is happening to the price of crude at that time? Basically, correlation tells how much prices are deviated from average. To get the deviation, we subtract each specific price with average price. We multiply both the deviations of the same time period together. Now we are looking at the overall picture. That's why we add all the multiplied values of the same time period. Units of two assets can be different, and we are looking at average deviation, so we square the deviations. Correlation statistics help investors in getting the correlation between two variables.